Hello everyone, welcome to This Week in the Markets. Information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regard to your objectives, financial situation and needs.
Welcome to another round of market updates. Today we cover economic data, financial market omens, equities, and FX markets. In economic news, ISM manufacturing PMI came in below the 50 threshold and the forecast of 50.6 with a headline of 49, providing confidence to investors of further Fed stimulus. The UK PMI came in at above forecast and had a positive impact on the cable as it advanced 160 pips. The positive PMI readings signal expansion for the second month running and is poised to boost optimism that Britain is on the path to economic recovery. The pair will now look forward to the Bank of England meeting, who is expected to refrain from any further action on monetary policy. US trade data widened further in April, reflecting a rebound in imports of consumer goods and business equipment, easing concerns of slowing economic growth. The gap grew by 8.5% to $40 billion from $37 billion in March. In equities, the S&P 500 has fallen off its record and is approaching short-term support at 1597. The move may be another case of buy the dip as bullish investors attempt to make one more push towards 1700. As equities take a breather from breaking records, the Hindenburg omen has made itself known, a popular bearish signal. Now, the last time this omen was triggered, in August 2010, the S&P 500 rallied to close at 1263 by the year end. A closer look at the list of new highs in the omen shows us that most of the stocks hitting new highs weren't actually the stocks of companies, but closed-ended fixed income securities, preferred stocks, or some other form of fixed income product masquerading as stocks. Now, of the 92 issues that hit new highs, only 7 were common stocks. Now, the lesson here is to remember to be careful when taking bullish or bearish signals at face value. In credit markets, investment-grade credit spreads are trading at their widest since the first day of the year, and also the biggest range since November 2011. The last time the spread was at these levels was in early 2011, and the rise in the range then signaled the start of a correction. The move is further emphasized by more declines in junk-grade bonds trending lower. Historically, liquidity does have certain lessons one can learn from. In 1930 to 1931, in spite of an expansion of liquidity, the stock market collapsed and investors raced into treasuries. The 1930s tells us that the time lag between growth momentum of liquidity and the beginning of a new bull market can be extremely long. Now, one factor that extends this lag is that an increase in liquidity amidst economic hardship is not a positive incentive for many investors to buy into stocks. Liquidity, in this instance, was supported by treasuries. The yield on the 10-year treasury bond was in a gentle downtrend. The yield eased from 3.4% in December 1929 to around 3% by June 1931. This is not to suggest that today is the modern day 1930, but it does suggest that there are often very large time lags between increases or decreases in liquidity and the expected reaction of stock prices, and moreover, that an increase in liquidity alone is not necessarily sufficient to drive stock prices up. In FX markets, recent moves have taken the euro and the pound higher against the Aussie. The euro is approaching resistance after a rally from 1.22. Technically, the CCI and the RSI are suggesting that the pair is overbought in the short run. The pound Aussie is sitting at resistance with the stochastic and the RSI in their respective overbought regions. That's all for this week. On behalf of Trading Pursuits, we'd like to wish you profitable trading.